All right, let's talk about one of the biggest things that trips traders up, timeframes. We're going to pull back the curtain and really dig into the logic that separates the pros from pretty much everyone else. So let's just get right into it. For most people, changing the time frame on a chart, it's just like a zoom button, right? You zoom in to get a closer look, zoom out to see the bigger picture. But for the pros, for what we call smart money, it's completely different. For them, this is a control panel. It's a tool they use to manage their own psychology and, more importantly, to actually influence your decisions. And look, the stakes here could not be higher. This is not some tiny little detail we're talking about. If you get this wrong, you will always find yourself on the losing side of the market. I mean, over and over again. It's honestly the very reason why so many traders just can't make it. It's that big of a deal. Okay, so to really get this right, we've got to start by tearing down some of the most common myths, these beliefs that so many retail traders build their entire strategy around. It's time to separate what's real from what's just wrong. So here's a classic one. I'm sure you've heard it a million times. Hey, if you want to get in quick, you got to be on the 1-minute chart. I mean, the logic seems to make sense on the surface, doesn't it? Yeah, no, it's a complete myth. That kind of thinking mistakes all that chaotic, random price action for a real opportunity. It's a huge error that traps you in the most emotional, impulsive part of the market, and it's a recipe for disaster. And then there's the other side of the coin, this idea that using a daily chart or a 4-hour chart, well, that's just for slow, boring, long-term investors, that it's not for active traders who want to find opportunities right now. And that is also a total myth. I mean, what a fundamental misunderstanding. The speed of you clicking the mouse has almost nothing to do with the main time frame you use for your analysis. We're about to see that the pros know the higher time frame isn't slow, it's clear. It's where the real story of the market is actually being told. So this is really the key. Thinking of a time frame as a strategy itself, like a 5-minute strategy, is the big mistake. A time frame isn't a strategy. It's a lens. It's just a way of looking at the market's underlying truth. And different lenses are going to show you different parts of that truth. And that brings us to the real difference here. Retail traders, because they're so focused on those tiny time frames, they're basically just trading emotional noise, all those rapid, crazy price swings. The professionals, they anchor every single decision in the market's truth. And that truth is always found in the bigger picture, on the higher time frames. Okay, so if the way most people think is wrong, then what's right? Well, professionals use something called a time frame hierarchy. This is the secret playbook they use to build this complete, multi-dimensional view of the market before they even think about placing a trade. And it's actually so simple and elegant. It's a top-down approach. You always start big. The higher time frame, the HTF, that tells you the overall direction. Are we bullish? Are we bearish? Then you drop down to the medium time frame, or MTF, to find the specific price structure you're looking for, maybe a pullback or consolidation. And only then, at the very, very end, do you drill down to the lower time frame, the LTF, just to fine-tune your exact entry point. And what's so great about this is how practical it is. This isn't just theory, right? If you're an intraday trader, your bias, your direction, comes from the 1-hour or the 4-hour. The setup you're looking for is on the 15-minute. And your trigger, your actual entry, that's on the 5-minute or the 1-minute. See how that smallest time frame is the very last piece of the puzzle? Not the first. So how does this actually work in your brain? How do you apply this? Well, smart money traders are constantly asking themselves 3 very specific questions. Let's break down exactly how they think. Question number 1, and it's always number 1, is this: where are we in the big picture? Before they look at anything else, they have to get context. What's the main story the market is telling right now on that daily or 4-hour chart? So on this higher time frame, they're finding the major trend. They're marking out the key support and resistance levels, and they're mapping where the big supply, demand, and liquidity zones are. And based on that analysis alone, they make their most important decision. Am I looking to buy? Am I looking to sell? Or is the market just messy, which means it's a no trade day? Let me tell you, that last option is a pro's best friend. Only after they've got that high-level bias locked in do they ask the second question. Okay, what structure is forming right now? And then they drop down to a medium time frame, like the 1-hour or 15-minute, to see how price is acting inside that bigger context. Are we in a pullback? Are we getting a break of structure? This is where they start hunting for a potential setup. And then, finally, question 3. Where is my low-risk entry? This is the only reason they even look at a 5-minute or a 1-minute chart. It's not to figure out direction, it's purely for execution, to find that one precise spot that lets them use a tight stop loss and confirms their big picture idea. And this all boils down to the single most important rule that professionals live and die by. You never, ever let the noise on a 1-minute chart convince you to ignore a clear trend on the 4-hour chart. If the 4-hour is screaming uptrend, but the 1 minute looks scary and is dropping, you trust the 4-hour. You always trust the truth, not the noise. And here is exactly why that rule is so critical. Because institutions use this exact misunderstanding as a weapon against you. They'll set up a crystal clear trend on a higher time frame. Then they'll engineer a sharp, scary-looking move against that trend on the lower time frames. Retail traders, who live and breathe on those charts, see it, they panic, and they jump in going the wrong way. And bam! The institutions hunt their stops, grab all that liquidity, and then just continue pushing the market in the original direction they wanted all along. It's a classic trap. So let's wrap all this up into a simple, professional framework that you can literally start using on your next trade. This is about changing not just what's on your charts, but your entire way of thinking. The whole mindset shift is right here on this slide. A retail trader asks a broken question: which time frame is the best one? But a professional asks a much smarter question: what role does each time frame play in my decision-making process? You see the difference? One is looking for a magic bullet, the other is building a logical system. And when you really master this logic, you start to systematically get rid of the things that destroy trading accounts. You remove the confusion from conflicting signals. You remove the emotional trading based on noise. You remove those impulsive entries that have no context. And in their place, you start to build the real pillars of success: confidence in your ideas, consistency in how you act, and a truly professional mindset. So that really just leaves us with one final thought. Now that you've seen the logic, you have a choice. You can keep trading the noise, or you can start trading the truth. So the only question is, will your next trade be a professional one?